Thanks for being on Periscope. We're opening up our YouTube Live. And we are live on YouTube and on Periscope. Welcome to today's topic, 10 Rules for Financial Success from Burton, Malkiel. Hey, hi, good day. Welcome. You excited? Yay! And my name is May Duldalau. Started doing these signs because YouTube Live is like doing snapshots. And I'm like, I'll just write it down. Hi, Matthew. Hi, guys. Missed someone's name, but I live in Honolulu, Hawaii with my husband, Jamel, and my son, Jordan. He's 6 years old. He just turned 6 last week. I'm super excited. And I wanted to share with you, if you're on Periscope, you can actually see the view from my window. If you're on YouTube, I suppose I could flip you over. But basically, I'm going to show Periscope the view from my window. There's Diamond Head. I live in Waikiki, so that's where I live. I actually went surfing 3 times this week, which is super awesome because I used to surf every day before I gave birth, and now I'm surfing much more, so I'm super excited about that. Now, I used to not be very good with money. Hi guys, welcome. Hi, Bull, Bulgy, something. I used to have a lot of credit card debt, I actually calculated it January 2011. Hi, Fall Guy, welcome. In January 2011, I had $46,000 of credit card and consumer line debt. Hi, humbled guy, welcome. So that's a lot of debt, $46,000. Now, for you, maybe it is or not isn't a lot of debt, but for me, it was because I had a job at a bank. I was an assistant, and I made about $35,000 a year. Actually, a little less. Okay, so I made about $35,000 a year. And I had a debt of $46,000, and that's with credit cards and loan and personal lines of credit. So it ranged in interest rates from as low as like maybe 5% to as high as 14 or more percent. So it's a lot of interest. So 46,000 with interest being tacked on is a huge monster Goliath thing. And back then I wasn't very good with money. All right. So hi, Auntie, welcome, guys. And let me know where you're from. So what I did was I decided to learn from people who knew about money, and focus on, they all said, hi, Michelle, welcome. They said, even though you have a lot of debt and all that, focus on what you want, right? So I was like, okay, I'll focus on what I want. And so I started reading about financial freedom. I'm going to focus on financial freedom. I want financial freedom. So one of the things that you have to do to become financially free is create passive income, which is something my mind had no idea how to do back then. 2011, I was like, passive income, so I didn't know at the time credit cards were making a lot of passive income for me, right? But anyway, I was like, okay, I got to figure this out. Hi, Dai, go mom, and welcome. Let me know where you guys are from, all right? So I started focusing on passive income. I started learning how to make dividends in the stock market. I didn't realize that you could buy stocks and get paid dividends, and that you could pay yourself the dividends. I was like, wow, this is great. Hi, Charlie, 42,000, welcome. So I started doing that, and hello, welcome. Where are you from? So I ended up accumulating enough to pay our family about $500 a month in passive income. So right now we actually get more. I don't know, I have to calculate. But last time I checked, Hamburg, cool, in Germany. Hi, Sam, welcome. So welcome to the live on Facebook too. I had now, last time I checked, last month, we were making over $500 a month in passive income. And that's money coming in mostly from dividends into our checking accounts every month. So every month I calculate our cash flow net worth, financial freedom account numbers, and our, passive income. I track it. And then at that time, I transfer all the passive income into our accounts. So that's how it works. So it's just a monthly process I do. So I got into the groove of that. I started paying myself first, investing. That was back in 2011, okay? Fast forward 2016, which I said now we're making over $500 a month in passive income. Not only that, in 2016, I quit my job at the bank. And I also started full-time coach. Well, not full-time. I'm a full-time mommy. I started being a full-time mother. So my son at the time, hi, CCC777, welcome. Where are you from? We have someone from Hamburg, Germany on, which is cool. My son, when I quit my job, was 3 years old. And I really wanted to spend time with him before he grew up. You know what I mean? I want to be a mommy. So I quit my job, became a full-time mother and part-time finance freedom coach. And by that time in 2016, my husband and I had improved our net worth by $500,000. We used to have a lot of debt, but we paid off all our debt. Okay, so all our debt was gone by April of 2016. All right. In 2017, we bought our first condo together in Waikiki. That my mom runs and we pay her. And then it makes us a little bit of money too. And also, in addition to that, we sold our first business. The first condo we bought, we converted into another Airbnb business. So we had 2 Airbnb businesses. We sold that to our manager, who is also one of our Finance Freedom Mastermind members. All right, so he has a profitable Airbnb business now. We use the money to buy this 2-bedroom condo in Waikiki where we are now. So that's kind of a rough idea. In 2017, we went on a 1-month vacation, not a whole month, but over the year we went on 1 month worth of vacation to Washington, D.C. I took my first cruise with Jordan to the Mexican Riviera with my husband too. That was a 7-day cruise. We went to Toronto, Niagara Falls, LA. So this is my story. So you kind of understand, hi Scooter, via who I am and why I even talk about financial freedom. So I noticed when I was working on creating passive income and creating financial freedom that I talked to financial advisors and I'd ask them for advice, right? Thank you. I'd ask them for advice and they would basically say they didn't know how to they weren't making any passive income. They didn't know how to do it, or they wouldn't tell me. They'd get mad that I asked, right? So it was really hard to get good advice from anyone. So I had to just learn it on my own. So I'm here to help you if you're out there asking people and they're not giving you any advice. And the truth is, hi 214 Santi, which you'll find out also in this book today, which we're going to talk about, is that I've got 6 figures. I don't know what you mean by that. But anyway, if you mean my net worth is 6 figures, yes. Over. But anyway, so moving on. That's my story. So if you didn't catch the story of how I went from all this debt to, creating all this wealth, then just go back to the beginning and rewind and replay. Okay. So if you want to learn more about me, click on the link in my Periscope profile, or if you're on YouTube, click on the link under the YouTube video. Go to my blog. It's called yesfinanciallyfree.com. Okay. Yesfinanciallyfree.com. Wow, super heart. Wow, thank you, Puna. Appreciate it. Okay. So anyways, that's the blog. It's got free information. It's got free information. Okay. All on my blog. And I've been blogging for years. And I started blogging when I was, in the middle of creating the passive income, still had the debt. I was blogging, I was learning. And then now that all the debt's gone and we still have the passive income and I don't have to work a job anymore, it's a very different feeling. All right. Rewind, Santi, rewind. Hi, Jason Avasco. So my blog, yesfinanciallyfree.com, has a replay of everything I do. So you see this Periscope Live. I'm also on YouTube Live. There's a replay on my blog every week. All right. And hi, Jason. No, I'm not in affiliate marketing. And on the right side of my blog, you put in your first name and your email address. Oh, Jason! Jason! I just saw Jason at Costco. Okay, guys, I was at Costco the other day. I got to say this. He's on Periscope. I was on Costco the other day, and I'm in line, right, buying stuff with my son. And he's like, I seen you on a scope. And I was like, well, I do Periscope. I've been doing it for years, so maybe. It's like at Ala Moana. I was like, yeah, I used to do it back there. And, a couple years ago, he's like, yeah. I was like, I remember. I was like, and there he is. And he was in my checkout line. And he's like, I see you on their scope. It was funny. Anyway. Hey, Jason, welcome to the scope again. Nice to see you again. In live at Costco and in person on the scope. Okay. Get ready to become financially free. Right, guys? Right, guys? So go to the blog, thanks for the hearts, Go to the blog, yesfinanciallyfree.com for free information, replays of everything I'm talking about. I also write it out in case you don't want to watch a whole video. You can just read it, but it's not there for this week. But last week's topic's all there. The topic, so that's a good way to stay in touch. Get on the email list by going on the right side, name, email address, and then I email out the topics that I'm going to broadcast every week. And I tell you what time I will be live, right? Because it's not always the same. So if you get on my email list, you'll know exactly when I'll be live, when I'll be on Periscope, when I'll be on YouTube, when I'll be on Instagram Live. I send out the links. Okay. So just telling you guys right now. All right. I'm not sure what you're asking me to do right now, but if you click on the link in the profile, you'll go to the blog, I think, in Periscope. So that's the easiest way to do it. Okay. And finally, before I start, this great topic of 10 rules for financial success from Burton Malkiel, he's a super cool guy. Just want to say, I have a program. It's a mastermind program. It's called Finance Freedom Mastermind. All right. And it costs $5,000 a year. All right. So if you want live coaching with me once a week, and you get actually twice a week, and you also get one personal session every month to do your financial numbers, chart them out and put them in a chart. Because we graph our numbers so we can increase them, right? If you want to do that with me for a whole year, it costs $5,000. Just so you guys know, I'll throw that out there, okay? It's financefreedommastermind.com/FFM. All right, Finance Freedom Mastermind, FFM. Pretty sure that's the link. If it's not, email me, let me know. Now, if you want something a lot more low cost, I've got the 7-day Finance Freedom Challenge. That's for people who don't make any passive income, have no idea how to make dividend income, have no idea, they have no savings. They're just like, I don't know what I'm doing. If you're like that and you want to start making passive income right away, there's a 7-day Finance Freedom Challenge, and it costs $7. I know, it's so cheap. It's emails, 7 emails, and it has all the instructions on everything you have to do each day. Yeah, dividend income mostly, and also high yield savings account income. That's the 2 streams of passive income, which I think are the 2 most basic that everyone should start with. And then after that, move from there. So it'll teach you the basics of how to figure out how to find high yielding dividend stocks, how to even get high yield dividend yielding stocks. It'll teach you how to find a high yield savings account, how to start doing that, how to track, how to create a system of savings and investing. And it's a 7-day email challenge. So you pay $7 and you get 1 email every day for 7 days. All right. Follow the instructions. Okay. If you just read it, nothing's going to happen. But if you actually follow the instructions, and they're doable, I've had moms, working mothers email me and say, this is great. I love it. A lot of people have gone through it. They love it. Okay. So if you want to do it, it's at financefreedommastermind.com/7day, DAY, 7-day. Okay. financefreedommastermind.com/7day. It's also on my blog on the right side. So just so you guys kind of get an idea of what I have to offer you before we get started. Now today, every week I have free great broadcasts with free awesome information. So today we're going to talk about the 10 rules for financial success from Burton Malkiel. My name is May Dildal. Now, who is Burton Malkiel? He wrote this book. This is where I'm getting it from, this book, The Random Walk to Investing, 10 Rules for Financial Success from Burton Malkiel. Burton Malkiel was a professor. He is a professor. I think he's still a professor. He was at the time of writing this book. He was a professor at Princeton University. All right. And he wrote this book called The Random Walk Down Wall Street, which is bestseller. And basically it says that people who pick stocks will never be better than an index fund. And he did all these analyses, I guess. I haven't read that book yet, but that's what I gather it's about from reading. I read a lot of books that talked about his book. So I'm like, I'm going to just read his book, The guy seems to be very intelligent. So he was asked to write a shorter book than his Random Walk Down Wall Street book, which is much thicker. Actually, I have a copy of it over there, but it's like this thick, right? This one's a lot thinner, easier to read. And it's for regular people who don't want to do all the math. Okay, so he just kind of explains what you can do to invest and be successful. All right, so it's really neat. I actually really enjoy reading it. There's a lot going on in it, so we'll just go over it. All right, so I'm just going to go over the 10 rules for financial success. So you guys got them down. If you want to know more about it, I checked this book out from the library. So, I mean, you can get this from your local library, or you can buy it, or whatever you want to do with it, get the audiobook. It's not very long, but it's really good read, especially if you need basic advice. Okay, so basic point number 1, fire your investment advisor. I thought that was pretty cool. Fire your investment advisor. All right, so if you have an investment advisor, don't use him anymore. Fire him. Fire your investment advisor. Just try to make sure I'm doing this right. Rule 4, rule 2, keep a steady course. What's rule 1? Let's see, what's rule 1? Rule 1, start saving now, not later. Oh, okay. So actually what I'm talking about here is the basics. Sorry, I'm getting a little confused. Hi, Lee. So he has this little section in the beginning called the basics. And he's saying fire your investment advisor, number 1, because they're a middleman. They're taking money out of your pocket. Number 2, focus on 4 investment categories, which are cash, bonds, common stocks, and real estate. All right. And then his another basic point he says is, let's see if he has anything. Understand the risk and return relationship. He's saying all investments have risk and return, so it's good to understand. He says the more return you get, the more risk. That's what he says. Now, I've heard people who say the opposite, but that's what he says, okay? Now we're going to go on to the rules. So you got the basics. Fire investment advisor, focus on cash, bonds, stocks, real estate, and understand risk and return, okay? Hi, Iron Byron. So rule number 1, start saving now, not later. Time is money. So rule number 1 is basically saying you got to start now. Doesn't matter what's going on in your life, start saving now. He has one exception to that. He says if you're paying credit card debt at 18%, pay that off first. Other than that, he says start saving now. And he says no matter what you save, just start now. All right? Start now, because the more you'll make more the longer you are in the market. That's what he says. All right? He says you'll make more the longer you are in the market. So you might as well just start now. And it has nothing to do with timing. He said he did these studies where he had this one person would get in and out with great timing, and this other woman would get in and out with horrible timing, and she started longer than the other person, and she still made more money than this guy, right? So he's saying that it's time in the market, not what you invest in necessarily. Well, no, what you invest in is important too, but time in the market. Hey, FG, welcome. Thanks for the heart and the thumbs up. Start saving now. Start saving now, not later. So that's his first tip. And he has this cool story in it. I don't know if you guys have heard the story, so I'm going to read it to you just so you got it. Because I've heard it from Tony Robbins, and I've heard it basically from Tony Robbins, somewhere else too. But William and James are twin brothers who are 65 years old. 45 years ago, at the end of the year when he reached age 20, William, he started an IRA and put $2,000 into the account at the end of each year. All right. So one of the brothers, William, they're twin brothers, he started investing 45 years ago. So when he was 20 years old, he started $2,000 IRA at the end of each year. After 20 years, he stopped putting money in. Okay. He just let it accumulate, let it grow by itself. All right. It produced 10% a year tax-free. Okay. All right. James, his other brother, started his IRA when he was 40 years old. That's when William stopped his IRA. He put in the same amount, $2,000 at the end of every year, but he did it for an extra 5 years. He did it for 25 years. He just made his last deposit today. Hi, Frank666, welcome. Who has more money? What are the values of their IRAs, right? So, if you know the answer of compound interest and timing, William, the one who started earlier but put in less money, his IRA today is worth almost $1.25 million. $1.25 million. That's how much his IRA is worth. Now, James's IRA is worth less than $200,000. So that is a difference of over $1 million. The huge difference, right? So just starting earlier with less money and just leaving it there for another 20 years will give you a $1 million advantage over starting later and just putting in more money, but not having the added accumulation. So that's his famous story. So now you've heard it, right? So 1.25 million versus less than 200,000 just by starting early. So what he's saying is just start now. It doesn't matter how old you are, just start now. Okay. Rule number 2, keep a steady course. The only sure road to wealth is regular savings. So he's saying save regularly. And the first thing he says is pay yourself first. How do you pay yourself first? Well, he recommends you tell your employer, whoever is paying you money, to take out part of your money before you can see it and put it aside, maybe in a 401k or something. Pay yourself first. Always pay yourself first. That way you'll always have enough money to save because you pay it first and then everything else is for whatever else. All right. And then he's basically saying you can find a save more tomorrow plan. There's a plan where if you get a raise, you can automatically save like half your raise every time you get a raise, and then you'll up to the maximum you can save, and that's a good way to save if you have problems doing it right now. Make out a budget, monitor your expenses, cut your expenses. You know, he says instead of going out to a movie, rent a movie. You know, so all these things, think of time, you know, opportunity cost, be saving in your spending, pay off your credit card balance. So this is what he says. Consider pushing retirement back a few years if you're not ready, you know, downsize your lifestyle, start saving now, make the most of your home equity. So a lot of us, including me, might live in a really nice place, right? But we don't have to live in that place. We could actually downsize, go into a smaller place or not as nice a place, still be okay, but pay way less in money, right? So that things like that, right? And that's just living. Maybe it's car insurance, maybe you have this car and it's like the car payments are huge, whereas you could have bought a used car, you have no car payments, you know. There's various things in our life that will adjust how much money we have. So he's saying find a way so that you definitely can save as much money as possible for the longest amount of time, all right? And he also mentions The Millionaire Next Door, which is a great book. Highly recommend you guys read it, The Millionaire Next Door. I read that book. Basically, it's saying that a lot of millionaires, the people who wrote the book Millionaire Next Door, they went to all the fancy neighborhoods to look for the millionaires, and there were no millionaires in the fancy neighborhoods. The millionaires were actually driving like pickup trucks. They lived in very modest houses, and they're just really good at saving and investing. Whereas the people who lived in the fancy neighborhoods, well, that they were just good at spending money. They really actually didn't have $1 million net worth or anything. Okay, Don the Goat, welcome. Rule number 3, don't be caught empty-handed. Have insurance and have cash reserves. So he's saying you really do need to have some kind of a cash reserve. You need to have cash on hand. It's good to have cash as a cushion for whatever. So he recommends, you know, you put aside some money. And he has some actual like low expense money market funds here, which are kind of interesting. Money market funds make like nothing, you know, it's all good. But he has a list, which is cool, right? With the websites, so you can go look yourself and see what they have now. So I like how he does that though in this book. He has all these resources. It's so cool. And he puts the website address right in there. So it's real easy to find. So it's really neat. So he's saying put aside money, all right? Save money as a cash reserve. Save up a bunch of cash, all right? You need cash. And get insurance. Buy insurance. Now, you only need insurance, right, if you have children for life insurance, he's saying. He's saying if you're single, you have no kids, you don't really need life insurance. But if you do have children, you really need to get life insurance, right? So he's saying get life insurance. But he recommends you do not get anything but term because anything else is too expensive. And he recommends that you buy it directly from the insurance company and not from an insurance agent because insurance agents charge commissions, right? So when you buy from an insurance agent, you know, your friend, your uncle, your auntie, whatever, they sell you insurance, right? They get a commission. That's how they get paid. You can actually buy insurance directly from the company and it'll be cheaper because they take the commission out. And I thought that was super cool. And he had like a website here you could go to compare. And he's like, make sure it's a highly rated insurance agency. But without the commission for the salesperson, you pay way less for your insurance. And then you can use that money to invest. And I was like, huh, Never even thought of that. So it's amazing. He says, stay away from variable annuities unless you're super, super ultra wealthy or something. Stay away from variable annuities. They're just expensive in general because they just don't make sense monetary wise. So save money, get insurance. But don't, he says term insurance is all you need. Don't do whole life. He says don't do any of that stuff. Rule number 4. Okay. Stiff the tax collector. He says stiff the tax collector. How do you do that? He says put a lot of your savings into retirement accounts so that you don't have to pay taxes. Now he says you might have to figure out if you're going to do Roth or if you're going to do traditional, but do it in a retirement account so that you can save on taxes, okay? If you do it in a traditional and it reduces your taxes, like you put it in and it reduces your tax burden considerably, it might be good for you to do that, right? It might be easier for you to do that because it doesn't feel so painful. But you will have to pay taxes when you pull it out on any gains, okay? So that's on the whole thing actually. So if it's growing to 1.25 million, like William, you'll have to pay your tax on the money as you take it out. If you do a Roth IRA, right, you already paid tax on the money. So you pay tax today, you put it in, it grows, and even on the gains when you take them out, they're all tax-free. So that's actually a good, so he's like, you might want to do either one. He's like, if you're about to if you're putting it in a traditional IRA and you're not getting tax savings, then you should just do a Roth because there's no point in doing a traditional if you're not getting any tax savings. That's the only thing. But he says you gotta figure it out. But he definitely says use tax advantage plans so you don't pay taxes. Hi, Art Division, welcome. Pension plans, 401k, 403b, he recommends doing that. Self-employed code plans, he recommends doing that. Max yourself out on all your retirement plans, he says, because you don't want to pay taxes because taxes are huge, right? Hi, Black Rebel 68. So he has some priorities in here on saving for retirement. So I'm going to list them for you. First thing, contribute to your employer 401k or 403b up to the limit for employer match. All right? Hate taxes. Well, I like what, I have no comment. Okay. Yeah. So your employer will match if your employer is matching you in your 401k, definitely put aside enough money for the match, right? Because that's just money they're going to give you extra in addition to your salary. So definitely do that, all right? Second, contribute to your employer plan or your IRA or your self-employment plan, your COIC plan, or other tax advantage plan to the maximum contributed limit, right? That will be tax deductible. Fund your IRA, even if it is not, this is third, fund your IRA even if it is not tax deductible. Any earnings will accumulate tax deferred, and everyone who should make contributions up to the limit, okay? Fourth, once you have maxed out all other tax advantage opportunities, he says you could consider a variable annuity contract, all right? Which has the advantage of tax deferral. Welcome, Tio, to your first day of Periscope. Okay, so max everything out, and then fifth rule, buy tax-exempt bonds issued by entities within your state, buy common stocks through the tax-efficient index funds. So basically, he's saying you should max out every IRA, every 401k option before you even start investing outside. That's what he says, okay? Now, he says, but remember, if you put money in, you can't take it out before your retirement age. Otherwise, they charge you taxes, and then they'll take another 10% out as a penalty, just so you know. But he thinks that's a good idea because it'll force everyone to save money instead of spend it all the time, and he thinks that's actually a good thing. So, and then he talks about tax-free strategies for education savings bonds. I did look at what he talked about. They make 0.01%. Holy smokes, that's so low. I don't know. Doesn't seem worth it. Okay. Because even if you put your kid's savings in a high-yield savings account that's making 2 point whatever percent it's making, even after taxes, they're still making more than 0.01%. So, geez, it's crazy. But, I mean, he wrote this book back in, when did he write this? I don't even know. Back a while ago. Let's see, copyright 2003. So, geez, guys, this is before the real estate crisis. So some of the stuff in here is a little dated, but the cool thing, like I said, is he puts the websites to everything. So he put the Treasury website in here. So I went and I looked at the bonds to see what they were doing. And yeah, they're not very good. But good to take a look, right? Rule number 5, match your asset mix to your investment personality. How to allocate your assets. So basically, he says you should put aside a certain amount of money into cash, bonds, stocks, and real estate. Now, the reason he says that is because back in 2003 when he wrote this, and there was a, remember, I don't know if you guys remember, but in 2000 to 2003, there was the tech bubble, right? That was when the internet was super, super crazy, right? And everyone was investing in tech stocks like mad, right? And Warren Buffett was like not investing anything. It was like, I'm staying away from all this. And they were all calling Warren Buffett a fool. And then the tech bubble happened and everything went brrr. That was 2000, 2003. All right. That was the tech bubble. So he wrote this book at the end of the tech bubble. All right. So he just went through the whole tech bubble. Everything was like, So what does this mean? Back then in 2000, 2003, during the tech bubble, when stocks went down, bonds actually were fine. All right. Hi, Tinsy7. However, he did not go through the real estate crash of 2008, 2009, all the time. And as we may or may not know, bonds and stocks both went down in that crash. So bonds being a sure thing against stocks is not actually necessarily true. But this is what he says to do. And I'm not saying that it's bad or anything, but this is what he says. And he's a Princeton professor. And he might have changed his investment allocation recently. So you probably have to Google him, see, but it's possible. But he basically says that whatever you do, you should invest for the maximum amount of time, right, that you can. So put it in the market and just leave it there and let it grow. And don't do anything with it. Do it as long as you can, that's for sure. But he also says that it depends on your personality. So if you look at the stock market and you can't sleep at night, like you're looking at your money go up and down and you can't sleep, he's saying take out as much money as you can so that you can sleep at night, so that you're not worried, you don't look at it, you don't care. All right. So you got to get to a point where you feel okay. All right. So everyone's risk tolerance is different. All right. Like my husband's risk tolerance is very low. He sees the stock market going down, he'll freak out. All right. Now me, I have a higher risk tolerance. I don't even look at it. You know, it's like, don't even look at the stock market. So I look at it once a month when I pull dividends and do a quick analysis to make sure that our dividend yielding stocks are still producing dividends and stuff like that. And other than that, I just don't even really look at it. Don't read news about it, nothing. So depends on your risk tolerance. But if you are very low risk tolerance, then you should invest less in stocks because they're very risky. Okay, they're going to go up and down. They're going to do crazy things. So basically, he thinks you should do cash, bonds, real estate, and stocks generally. Okay, and he believes that, I think he says it in here. Let me see. I know he says it somewhere, but he says you should own your own home if you can afford it. He doesn't really say. Okay, now rule number 6. I got to go fast because I got another broadcast I got to do. Rule number 6, never forget that diversity reduces adversity. Diversity. So he says to diversify. He's one of those people who says diversify, diversify. Okay? Diversify your stuff. He has these different statistics, but what he recommends is that you buy everything over time. You do dollar cost averaging, which means you make small investments over time. Why would you do that? Because sometimes the market's down, sometimes the market's up. If you're doing it consistently all the time, you're going to buy it when it's down. You're going to buy it when it's up, but you're going to buy it no matter what. And over time, averaging, because it keeps going up, you're going to do okay. That's what he's saying. Hi, Rick. Hi, Superfans. Welcome to the Scope. Nice to see you. So that's what he's saying, okay? Next one. Rule number 7, pay yourself, not the piper. What does that mean? Invest with me, and when you are ready to retire, I'll take half your retirement nest egg as my fee. So he's basically saying don't pay credit cards interest. All right, he's saying don't do that. Get rid of your credit card bills, right? Because you don't want to pay interest there. Don't get into mutual funds because they are expensive unless they are index fund, low expense index funds. Cost matters for all financial products. So don't pay commission costs. All right. That's why he says to buy your insurance directly from the insurance company, not from a salesman, because they have commissions and it makes it more expensive. If you're going to get an index fund, he recommends that you get a very low cost mutual fund index fund. And if your retirement account doesn't have it, tell your employer to get it in the plan. So that's what he says to do. Number 8, bow to the wisdom of the market. Rule number 8, and this is, I think, based on his book, is that the market is smarter than you. You cannot out-time it. You cannot out-trade it. It doesn't, your timing isn't all that it's up to me. You know, the index always wins, stuff like that. Okay? So, and then he actually has a list of hot mutual funds and all the losses they took over the years. They took tons of, all of them were negative. None of them were positive. So if you get an actually managed mutual fund, you are very highly likely to get a loss. Now, there are some people who are really good at it, but you don't know who they are, and most of them are really bad. So stay away from all that and just buy an index fund. That's his rule, okay? Even Warren Buffett says that. Warren Buffett says you should get an index fund. Low cost. Okay, rule number 9, back proven winners, index funds. And here he talks about index funds, okay? So buy index funds, all right? He says for most regular working class people, do not do ETFs because they charge a lot of charges, all right? For people who are just saving and they're just consistently saving, do a mutual fund that has a low cost mutual fund index fund, all right? Just follow you. Can you follow back? I live in Big Island. Sure, later. What index and what fund should be chosen? He recommends you should do the entire stock market. So he has things like Fidelity Spartan Total Index, Schwab 1000 Investor, T. Rowe Price Total Equity Market Index, TIAA CREE Equity Index Fund, Vanguard Total Stock Market Index. He says you should do the entire stock market, the whole thing. Just do the whole thing. That way you won't miss out on the small companies. You won't miss out on anybody. It'll be just awesome. Rule number 10, don't be your own worst enemy. Avoid stupid investor tricks. He says that investors are often overconfident. They will follow the herd. You know, if everyone's talking about Bitcoin, right? Oh my God, are you in Bitcoin yet? It keeps going up and up and up. Oh my gosh, you're going to lose out. We're all going to be millionaires and you're not going to be one. You're going to be like, ah, that's the herd mentality. Don't pretend you're in control of your investing when you don't know jack about the market or anything, right? A lot of people will avoid loss. Hi. So they won't sell losers, all right? But they'll keep winners longer than they should, but they won't sell their losers, all right? Loser stocks. So there's all these psychological pitfalls that we fall for. He's saying don't fall for these, all right? And that's it. Those are the 10 rules. Hope you enjoyed this. I will be writing this out on a blog, but I wanted to get this live out. Thanks for being on. I appreciate you. Thanks for following me. Those of you followed, thanks for all the hearts and super hearts. Thank you very much. I appreciate you guys. I'm going to do an Instagram live right now, so I'm going to jump off. If you're on my email list, you have the link to the Instagram live. I'm going to do that next. Yeah, if I lose, I would never sell. All right, see you guys. Aloha.